and welcome to the strategic analysis part of the strategic case study pre-scene analysis video series for the August 2017 case study on electronics manufacturer AutoAuto. So before we start, we'll just have a brief overview of the case. Now, of course, it's the automotive electronics industry. The company creates specific safety modcons, so to speak, for various different car manufacturers who then put them in their cars. Now, of course, this is quite a familiar industry in terms of the end result. We've all perhaps sat in cars that have got built-in sat-nav systems, that have parking sensors, that have cruise control. I'm sure it's things that many of us have used before, but perhaps a lot of us aren't familiar with the industry. I know I myself, before this case came out, sort of assumed that a lot of these things were made by the car manufacturer themselves. Now, if you were in a Mercedes and it had a cruise control system, you just assumed that was Mercedes' cruise control system. If you were in a Volvo and it had a cruise control system and parking sensors, you assumed that Volvo had made those. But actually, most car manufacturers in the world do not make their own electronics that go in their vehicles. So it's an interesting case for us to look at. And then there's a bit here about the company itself. So we know it's a successful listed business that operates out of the country of Upland. So let's take a look at how we're going to cover this information in this video. And we're going to use what is called the rational model. And what this essentially involves is taking a look at where we are now, the current position of the organization, and we look at the environment the company operates in, both the actual industry using 5 forces analysis, how competitive it is, how profitable it is, and also the greater environment in which it operates, so the upland environment, the global environment, and also looking at some things specific to the organization. We're also going to be looking at ultimately where the company wants to be. What does the company want to achieve? How does it want to be viewed? How does it want to run itself, etc.? And so we'll look at various stakeholders there, because ultimately that's one of the aims of an organization, is to be the best company that it can possibly be for all stakeholders involved. Often one of the ways in which they go about this is by having good governance and good ethics, good corporate social responsibility. And so once we have looked at where we want to be and where we are now, we of course need to look at how we are going to get there. And that's where the business strategy comes in. This is the bridge between the now and the future. And in that section, we'll look at various different models for growth, how the company can grow, what perhaps are the best ways for the organization to grow, and use various different models such as Ansof's matrix, the methods of growth, or the 4 methods of growth, and Porter's generic strategies, the main 3 things that we'll cover in that section. And so we'll kick the analysis off by looking at where we want to be, which position, where is the organization heading, where does it want to be in a few years' time, where does it want to see itself, or where does it see itself? And the first thing we'll look at is mission statements. Now, mission statements are very important when it comes to illustrating and defining what the company is about. So I've summarized some of them here. What is the company about? Why does it exist? Why are we providing these electronic safety devices to go into organizations? Are we doing it to make money, purely to make money? Of course, that's, is something that the company needs to do because it's a for-profit entity, but there are plenty of things that the company could do to make money besides creating safety devices for cars. So, of course, there will be other things that the company will be trying to achieve as well. So are we trying to reduce the number of deaths on the road? Are we trying to reduce the emissions released by vehicles by encouraging people or nudging people to drive more safely? Who does it exist for? Does it exist for members of the public to cut down on their fuel costs? Does it exist to help people who are cyclists or pedestrians, etc., to be safer when they are walking or cycling along the roadside? And what is the organisation trying to achieve? And a good mission statement answers all these questions. Now, we've got 4 different elements for mission statements here. So essentially, we've taken those questions that we asked at the very start of this section and split them up by the 4 different elements. So the first one we've got here is purpose. So why does the organisation exist? For who does it exist? What is it trying to achieve in the long term? Now, of course, we know that the current mission statement of AutoAuto is to make vehicles drive themselves. Their mission statement is making vehicles drive themselves. So that is their long-term aim. Now, this is a good mission statement, particularly with regards to purpose. It answers all these questions. So for who does it exist? Well, for whoever drives a vehicle, whoever uses a vehicle, whoever is affected by a vehicle, such as a cyclist. And that is what they hope to achieve in the long term, to make vehicles drive themselves. Now, this mission statement was created a long time ago, long before driverless cars were an actual reality, and the phrase making vehicles drive themselves would have been used more as a saying, so to speak. You know, when you say that something is so easy that it practically does it itself. You know, it's not literally doing it itself. You're just making the act of driving so much more simple, so much more safer that it's like the car is driving itself. But the problem with this mission statement is that a mission statement is supposed to be something that is big and broad and vague and in the future. And now the mission statement of the organisation is almost at the point where it may literally be met, it may literally be achieved. Because, of course, driverless cars are becoming a reality, and AutoAuto is one of the driving companies within that industry. And so it could be that we need to think about changing the mission statement. Once driverless cars become more of a likelihood, once it becomes apparent that they are going to be released in the next few years, etc., we may need to change the mission statement because we've, in a sense, achieved it. And this would be a good time for the organisation to bring in some of the other values, some of the other elements of what a good mission statement is, because whilst the mission statement we were given in the case does meet a lot of the requirements of purpose, arguably it doesn't really meet any of the other things. So if we look at strategy, how will the organisation compete, the range of businesses it's operating with? Possibly it can be inferred from the case study mission statement that obviously it's going to be competing with other vehicle electronic manufacturers or other vehicle manufacturers if the vehicle manufacturers are making some of the things themselves. But it's not telling us how they're competing. It's not going to tell us that they're competing by being the best value for money, etc. And that also stems from values here. What does the organisation stand for? Now, innovation is the big one that I've put on here. And that's because during the pre-scene it mentioned repeatedly about how the company values innovation, how the company wants to produce these disruptive technologies. That was the phrase used in the pre-scene to change the industry. And that's something that really needs to be mentioned in a mission statement. If that's what the company does value, they need to be putting that front and centre, so to speak, that we're the organisation that challenges the status quo, that breaks ground on the latest technology. And there was also no mention of policies. Now, policies are more to do with the organizations themselves, the people within the organization. So basically, how people within the organization help fulfill the above three elements. So a classic example is of the pharmaceutical company Johnson & Johnson, who have their credo, which is essentially a 4 or 5 paragraph long statement about how the company is there to provide a benefit to shareholders, how it's there to provide a benefit to society and the community as a whole, how it values corporate social responsibility, basically. It wasn't called that at the time, but the credo for Johnson & Johnson is 100 years old. It was doing it long before it became the norm for organizations to do that. And it's as part of that, people who work at Johnson & Johnson are given a copy of the credo when they join, and they're also presented with it when they go into the various buildings. The buildings owned by Johnson & Johnson have the credo as like a huge image, a huge picture in the reception area. And so what we would need to see here is more evidence of how the above three elements are dictated to employees. How are employees informed of the fact that they need to be constantly trying to break into new grounds when it comes to technology? How do we know that employees are focused on trying to make vehicles drive themselves? And perhaps there is evidence that from the pre-scene, if we look at issues with regards to products for consumers, direct-to-consumer products, like separate sat-navs that can be moved from car to car. The company has not produced any, despite the fact that they may be commercially viable, because it doesn't help them achieve their overall aim. Because building a separate sat-nav system that can be moved from one car to the other doesn't help make vehicles drive themselves. So perhaps that's evidence of the company acting within the confines of its mission statement, because it's not going to help it achieve its overall aim, therefore it's not what we want to do. So that's mission statements. Next thing to look at is performance measurement. So of course you can have all these goals of what you hope to achieve, all these targets of what you want to do, but of course you have to be able to monitor it. How are you going to monitor your performance to see if you are on your way to achieving your goals? And this is where something like the balanced scorecard comes in, which is a very crucial part of management accounting, particularly at earlier levels, at management level, but also it does appear in strategic level, particularly in your E3, P3 type exams and type questions. So essentially what the balanced scorecard is it's a separation of objectives, of measurements of the organization into different sections. And this is because, of course, in the olden days, you just looked at the finances. You just looked at how the company was performing, what kinds of returns were you producing for the shareholders. If you're producing good returns, the company was doing well. If you're doing badly, then the company was doing badly. So the point of this is to split it out by other factors that affect the organization. So we have the financial perspective, which of course is still relevant. This is how well the company is doing financially. We have the internal perspective. This is to do with a lot of internal operations, how efficient internal operations are. Learning perspective. This is often referred to as the company's capacity. And essentially it's all to do with how the company grows, how the company develops. And that's why the things mentioned on here are things like the amount of training projects completed. So improving the employees, improving employees' range of skills and abilities, number of new innovations, new products introduced to the market. Obviously that's going to help grow the organization, increase the revenue of the organization, and allow it to expand upon those new innovations. Because of course, a new piece of technology even if in itself it's not financially viable, it may open the doors to other advancements which are viable. And also successful patents and trademarks here, particularly in an industry like this where so much is driven by innovations and being the first to create a new piece of technology. The amount of patents and trademarks that you get pushed through the Upland legal system will be better for your organization. These will allow the company to grow and develop because it's creating new business opportunities for the organization. And finally, customer's perspective, which is how well you are doing with regards to your customers. That was very important as well, because without customers, you're not going to have much of a business. And so the standard sorts of things that fall under the customer perspective would be the number of customers. We learned in the pre-scene that it has that AutoAuto has some powerful but few customers. Now, this suggests that the company could do better by diversifying its customer portfolio. If we've only got a few huge businesses that we rely on for all of our revenue, then that provides them with a lot of power because we depend on them. If just one of them leaves, that could be 20% of the business just gone like that, which is a very risky situation for the organization to be in. We also have to think that there are many, many different car companies all around the world. So if the company is not currently exporting its goods from Upland, then perhaps there is an opportunity there. Number of complaints as well. So if you've got 5 different customers and all 5 have complained about your products, chances are you need to improve the quality of your product. We need to address these concerns. If you've got 500 customers and one has a half grievance about one thing, chances are you're doing something well. So customer complaints often exposed in a customer satisfaction survey. The reason why I mention this is that in the past there have been past papers or exams where the company has been presented with customer satisfaction surveys, and it's up to you to assess the values of these complaints. And so you have to take into account how much it's going to cost to rectify it, the size of the competitor in relation to others, or not competitor, customers in relation to others, also how easy, how logical it is to fix the situation. So put that in there because you might be given something like that in the unseen exam. So look back at the other two now, like we sort of skipped over as we were going through the overarching perspectives. So finance is very straightforward usually. It's all the kind of things that you'd think that a business would be measured for when it comes to money. So it's profit, the return on investment for investors, the cash flow of the organization. Cash flow obviously is very important. There's many companies in the past in these pre-scenes that have had good profit but have had poor cash flow statements. And of course, cash flow is very important for the short term. It doesn't matter how profitable your company might be at the end of the year, if you haven't got the money in the bank, the assets available to pay off your short-term debts, to pay off this month's bills, then it's going to cause problems, regardless of the fact that you're due to finish with lots of profit at the end of the year. Gearing, of course, is all to do with how much of the organization is funded by debt. The higher the gearing level, generally the riskier the company is. Now, we saw when we were going through the pre-scene videos that the company has either about 50% gearing or 101% gearing, depending on whether you use debt over equity or the debt over debt plus equity method. Now, there's nothing wrong with using either of those, but it's important that you always use the same one every time. If you keep switching, then you'll skew the analysis. So the company can perhaps set itself a target of reducing it's the level of debt running through the organization. And then gearing will be a great way to monitor that. As the gearing level goes down, so does the amount of debt financing within the organization, or at least the proportion of debt financing within the organization. And finally, hedging as well. Hedging would be things such as leading and lagging payments, invoicing in home currency, and just in general using various techniques to guard against the risk that you might lose out as a result of the transaction. Now, this is particularly relevant when a company trades with overseas countries, because often exchange rate risk is one of the big reasons why organizations hedge. So if you are losing money through exchange rates, then perhaps it's important to set up some sort of hedging system in your financial department and need to monitor effectively how much it is making, or how beneficial it is to the organization. Of course, gains made from hedging reserves can go into your statement of financial position, so that boosts the performance of the organization from a financial perspective as well as a risk management perspective. Internal perspective is the last one we'll look at then. This is all about your operations, how efficient your operations are, could you improve them, etc. And so the main ones I've listed here relate to primarily budgets, job completion, and employees. So employee utilization rates. What I mean by this is basically the amount of idle time that is accumulated by employees. We know we have a lot of employees, over 250 design engineers who will be on quite high salaries. We need to ensure that we're getting the most out of them. If there's time a day where at least half the employees are not doing anything, even if it's just for an hour or so, that could be thousands of Upland dollars a day that is costing us. That's thousands of man hours or hundreds of man hours that they could be doing something that benefits the organization. So it's important that we structure our organization in a way that there's no downtime for employees, because of course downtime is wasted time. Next two relate to jobs, projects, so the success of them, and also what proportion of them were completed on time, which of course is very important. Most jobs eventually get done as long as they're not impossible, but if they're not done on time, then they may not be profitable. For example, if you've got a project that is going to cost £1 million a week to do, and it takes 2 weeks, and when it's finished, it's commercially viable to the tune of 3 million Upland dollars. So cost 2 million and made 3 million. If that overshoots and takes 3 weeks at a cost of £1 million, £1 million Upland dollars per week, suddenly it's no longer profitable. It'll break even. And even worse, if it were to overshoot by twice and it were to take 4 weeks at a cost of £4 million Upland dollars, it's now in fact just having the project has lost you £1 million Upland dollars, because the commercial viability of that project was only 3 million Upland dollars. And that's also where the importance of budgets as well, and completing to budget, or even better, under budget. The more often that you are competing under budgets, then the more efficient your organization is running. And also employee satisfaction as well. This was mentioned in the pre-CIMA as being something that the organization was aware of, because of the fact that it requires such skilled talent, the design engineers, for example, and they're often headhunted or approached by other organizations, because of course there are big competitors in this industry within the Upland market who are all looking to try and grab the best design engineers. So keeping employees satisfied, and I guess this links into employee turnover as well, is one of the key metrics the company needs to be looking at from an internal perspective, because it's beneficial for the organization to keep a hold of its employees. And finally, investment in research and development. Now, arguably this could go in the learning perspective as well. But the learning perspective is more to do with the outcomes of investment in research and development. But investment in R&D itself is all to do with internal workings, internal management, internal budgets, etc. But we know that it's one of the biggest factors for the organization is investment in research and development, because this is where the business comes from, essentially. All the products that the business makes, all the products that the business makes revenue from, have come from research and development, because it is a tech company. It's a company that strives to be the most innovative, and that's what it's built itself as. And therefore, it can't rest on its laurels now. It has to keep investing and keep producing, keep making new products. And this is particularly relevant with regards to these new driverless car systems that might be coming out in the future. The company has a real opportunity here to be the first big manufacturer of driverless car systems. And it's very important to be the first, or very important to be one of the first at least, because of course there is an issue with standardization for economic reasons. If you look at, say, the train line systems in the UK, now in the trains used for 8 tracks in most of the country, and they used a 7-foot track width in other parts of the country. Now, the 7-foot track width was actually a superior system, but it was a more expensive system, and it was a system that wasn't used by as many train lines. And so eventually we had to get to a point where the 7-foot one had to be removed and replaced with a 4-foot 8 one. Now, if you're sitting there wondering why on earth is he going on about train track sizes, the point being that something like this, something that is going to have such a universal application, cannot exist in numerous different forms. You won't have a situation where, particularly if it's going to have an impact on the way that roads are designed, the way that infrastructure is done in general, if all the cars are going to be using completely different systems. Driverless car systems work on the basis that everyone is using a similar system, particularly if it's going to be controlled by a central system, particularly if it's going to be controlled by rails under the road, just as the robo-car system is. Now, one of those two is going to be the 7-foot tracks. That's the point I'm trying to say. And so if we invest lots of money into it and it doesn't come off, then it will all have been wasted money, and it could bankrupt the business, because that would be a huge portion of the revenue that it's not going to get, despite putting millions and millions and millions of upland dollars into it. So it's almost like they can't half-heartedly do it. Either we need to stop spending money on this now, or put everything into it to ensure that we are the most successful one. So the next section relates to governance. I'll briefly give you an overview of the theory of governance before going on to the specific parts related to the case. So essentially, governance is the way in which organizations are directed, administered, and controlled, with the aim of ensuring that the organization is run in a way that is right for all stakeholders. So essentially, ensuring that a business is run to benefit the stakeholders and society as a whole. So, sounds very good. And it's worth noting that this is only applicable to UK companies and listed companies at that, companies that trade on the stock exchange. But that's not to say that there aren't things that we can take from this and apply to any organization. It doesn't matter where that organization is based. Just as in our case, it's not based in the UK. And it doesn't even matter if the company isn't listed, because of course it's all about running the business in the best possible way. So just because you don't have to do it doesn't mean that you couldn't gain from it. Let's take a look at some of the few key factors from the Code of Governance. What is considered good governance? and that's having a separate chairman and CEO. Of course, the CEO is head of the organisation, and the board is ahead of the CEO. And so the CEO runs the organisation on behalf of the board, and then the chairman is the head of the board. So if you had a situation where the same person was the chairman and the CEO, they might be setting themselves targets they know they'll be able to achieve. So they're not pushing the company, trying to get the most out of the company, trying to achieve its potential. The chairman is just setting themselves easy targets that they know they'll be able to achieve so they can get their bonuses. Independent non-executive directors. These are people who are not employed by the organisation. They sit on the board to, in a sense, act as the control for the executive directors, to ensure that the executive directors are running the organisation in a way that is beneficial for stakeholders and not for themselves. This, of course, it goes some way to removing the issues caused with the agency problem. Now, agency problem is essentially where directors are running the organisation on behalf of the shareholders. Now, the shareholders own the company, the directors don't, but the directors are in charge of the company. So the directors perhaps aren't necessarily interested in the long-term viability of the organisation. They perhaps are more interested in their short-term gains. So they may leverage long-term sustainability, long-term growth for short successes, small successes, so that they can boost the share price of the organisation, so that they can boost the dividends paid out to the shareholders and get their bonuses and move on. And so that's the point of the non-executive directors. Non-executive directors also need to be people who are skilled, knowledgeable, not just any old person. They need to know whether what the executive directors are doing is right or wrong, and they have to be firm as well. There's a tendency for independent NEDs to not rock the boat because they're paid quite a handsome stipend for doing it. It's only a few days a year job, and so a lot of them don't bother doing it, or don't bother standing up, rocking the boat, where of course they have to. That is their job. And one of the main jobs for the NEDs is to sit on the Audit, Nomination and Remuneration Committees. Now, these are 3 different committees that, in a sense, are the essence of what governance is, ensuring that everything is done fairly and ethically. That's the Audit Committee, ensuring that executive directors are not using company funds to fund business trips and golf trips that the shareholders wouldn't approve of. For example, if an executive director is taking a client to Dubai for 2 weeks to discuss a business opportunity on the company's dime in a 5-star hotel, well, it could have just been a couple of hours meeting at the company's office. That would have been enough. Yet they chose to go on holiday for 2 weeks in a 5-star hotel. That's not an effective, efficient, correct use of company money, and that's the kind of thing that the Audit Committee is responsible for stopping. The Nomination Committee are in charge of selecting people to sit on the board, selecting the executive directors. And this to ensure that the chairman or the CEO doesn't simply bring their son or their daughter or their husband or their wife on board to the company to earn extra money for the family, to give them an opportunity. No, it needs to be someone who is right for the job, someone who is experienced, someone who has knowledge in the industry, and generally someone who is not related to other members of the board, because this of course affects their independence, this affects their ability to think, and perhaps increases the chance of them being biased. And remuneration committees as well. These are the committee, this is the committee responsible for deciding the pay on the directors. And this is because directors' pay, and this of directors has to be disclosed to the public, and so of course it's important to to come across with to come out with a fair level of payment. If the company that you work for is not doing so well, it made X million in losses and it's got to lay off employees, but then it's also found out that the director had a £40 million bonus this year, which was a 20% increase on last year's, then people are going to think, well, why? Why is that director getting a bonus, a raise, when the company has done worse this year than it did last year? The company didn't meet any of its targets. It was supposed to be trying to break even this year, and it made millions in losses, yet you've given the director a bigger bonus than you even did last year. That's the kind of thing that will really frustrate the public, turn the public against the organisation, turn the shareholders against the organisation, turn the other stakeholders, such as the employees, against the organisation. And that is what governance tries to overcome. It's also worth pointing out that governance has a risk management focus, particularly with regards to the audit committee. So the audit committee is often in charge of creating things like risk registers and other things like that ensure that risks are being dealt with. Because it's one thing to identify risks, it's another to actively go about mitigating the impact of those risks. And that's one of the values of corporate governance. Financial reporting and control, also very important, ensuring that all the statements are done as per the laws of the particular country in which the organisation operates in. Ensuring that directors have all the information they need, because of course they can't really be judged on their decision making if they aren't given the amount of information given. So this system is to ensure that all executive directors are provided with all the information that they need to facilitate good decision making. And with regards to decision making, that all directors are involved in it. And this means even if it means taking, something as simple as a show of hands, just ensuring that everyone is involved. Often, in certain situations, if you've got, say, founders of the company still sitting on the board, the founders are very powerful, everyone agrees with what the founder says. And that's against governance. The whole point of a board is that there is a consensus amongst a group of people rather than one person making all the decisions. So if that isn't happening, if one person or two people or half the board are far too powerful, then that goes against the point of a board and thus against the point of good corporate governance. And regular meetings with both institutional shareholders and all shareholders at the annual general meeting. Institutional shareholders, of course, being things like your pension schemes and your big stakeholders, big shareholders like that. And it's important that we do this because of the fact that they have a lot of money invested within the organisation. If they were to take their money out of the organisation, it could cause a lot of problems with the market because the share price might drop, as people may be thinking that there's something wrong with the organisation or it's on the decline because this major institutional shareholder has decided to take their money out of it. So that is governance from a theoretical perspective. Now let's take a look at governance applied to the specific case. So, of course, we know that the founders of AutoAuto are still involved in the organisation. Not only do they all sit on the board, including the position of CEO, they also still own shares in the organisation. In fact, shares to the tune of 25% between the three of them. So that's a quarter of the ownership as well as over a quarter of the board. So this is where, if you remember what I said on the slide before about whether founders sometimes can be too powerful, this is where the situation can arise, where you've got people who not only own shares, they sit in the top positions, and they're the founders of the organisation. They know the business better than anyone. So there's an argument that they are the right people for the job, but then there's also the argument that as they think that it's their company still, despite it being public and not really being their company anymore, they still may act act like it's their company. They may still expect people to do what they say because it's their company. And one thing I put here is the commitment of the founders to their board positions. Now, there wasn't necessarily anything in the case to suggest they weren't committed to their positions, but this is just something that we've seen in CIMA exams before. One of the very first case studies for the strategic case study was about an internet company called Look. It was based very much on Google. And the founders of the organization were sitting on the board. But the founders of the organization were very much tech types, internet types. They weren't interested in running a company. They weren't businessmen. They were tech guys. And they spent half or more time down in the office area coding and doing things like that than they did sitting in the boardroom. And this, of course, caused all sorts of problems with the shareholders, because the shareholders wanted people who were interested in running the organization rather than fulfilling their own personal pursuits. For the founders of Look, it was more about they wanted to keep on working, doing coding and creating new technologies themselves rather than running the organization. And so that kind of factor could potentially arise in the unseen exam. We saw that the three founders of the organization had background in the tech side. We've seen that particularly in the case of Abdul, how he is very much interested in continuing to create technologies, continuing to create designs, and that a lot of the patents within the organization will actually stem from Abdul's ideas. So what issue we may have here is that we've got a position where the board are recommending that the founders are removed from the board positions because of the fact that they're not committed to running the company. They're committed to being members of the board. They still want to be in their more management and operational level roles on the front line, so to speak. But on the flip side of that, we also have less potential for the agency problem to arise here. Because, of course, if your founders are your main executive directors, or most of your directors are founders of the organization who also own shares, they're less likely to leverage long-term growth in return for short-term rewards. And this, of course, is because it's their company, it's their legacy. They don't want to see it, decline. They wouldn't have built this company if they weren't interested in building a company. We also have to think that they own shares in the organization. Therefore, personally, their personal wealth is dependent on the long-term success of the company, the sustainability of the organization, because their money is tied up in these shares. So now on to the things that the company perhaps could do better. So when we looked at the list of the directors, of the board of directors, we saw that they only have 2 non-executive directors and a chairperson. Now the chairperson is a non-executive director too, but we look at the board, which just contains 9 people, and there is only 6 non-executive people, the chairman and 2 NEDs. Now, according to good governance, a good board should contain half of each, half non-executive directors and half executive directors. So we can see we're a bit behind in terms of executive director or non-executive directors. And so they could do with bringing on some more experience, wider business experience to the board, and to bring on some more NEDs to review and check board decisions. There's also no mention of the Remuneration, Nomination or Audit Committees. Not saying they didn't have them, but often when we are presented with a board of directors in a CIMA case study, if there are such committees, usually it says next to each person, this person sits on the Remuneration Committee, this person sits on the Nomination and Audit Committee, this person sits on the Remuneration and Audit Committee, etc. and no formal reviews, by the looks of it, of risk. There was a risk report, but there was no formal risk register where they'd been actively producing a report that focused purely on risks and looked at ways in which the company could mitigate the impact of those risks. So I think there's a lot of potential governance issues in the case study. So I hope you've enjoyed this sample video and more importantly found it useful. Before I go, I'd like to quickly tell you about a few of the products that we do here at Astranti Financial Training, specifically for our case study courses. We have a study text which details all the key theories in which you will be expected to use in your case study exam, as well as details of how to approach the pre-scene and the case study. We also have a series of course videos detailing how to answer case study questions. This is actually an area in which many students struggle. Most of the scripts that I've seen, the failing scripts that I've seen, has actually been due to poor case study technique rather than lack of knowledge. We also have a series of pre-scene analysis videos based on the current up-to-date pre-scene, detailing all the key bits of information and likely issues you may face in the exam. Next up is the industry analysis, a pack detailing information about the industry that the pre-scene company resides in, information about the key players within that industry, and more background information on the industry in general. We also have a range of mock exams created for each level and based on the current pre-scene, which is a great way to get some practice in before you sit the real thing. We also offer marking and feedback on those mock exams so you can see where you are going wrong and where you can improve. Finally, we have the master classes. These are 2 one-day classes taken by our expert tutors to give you all the hints and tips you need to really add to your chances of passing the exam. Also, if you take our full course, we offer a pass guarantee, which, provided you have met all the requirements of the pass guarantee, you will get a free resit on the next exam should you fail to pass. So once again, thank you for your time. If you're interested in any of these products, please visit the website www.astranti.com for more information. Thank you.